in Paris and Hong Kong and London. Then 7 years in the financial regulatory world, so in Brussels and at the European Commission and at ESMA, the European Supervisory Market Authority, based in Paris. And then the last part was in consulting, and I'm currently consulting for fintechs, as well as being at the board of one of a smaller fintech. Hans, same for you.
Yeah, thank you, Laurent, and hello, good afternoon to everybody. It's really also for me a great pleasure to have this fireside event and being back and interacting with Ecoda and the Ecoda alumni. Basically, what Laurent said, I mean, at least two of his three stations he had are to a certain extent similar to mine. The only one missing is the regulatory side. I worked for, actually, I've been working for almost 25 years now in the financial services sector. Half of it as a strategy and management consultant for various consultancies, amongst others, Oliver Wyman, which is relatively well known for risk management consulting in the financial services sector. And then I worked for the other part of it in two management boards for banks in Germany. One is a direct bank belonging to the German saving banking sector, and one is a bank that belongs to a UK-based fintech company. So, and from there, I bring in the experience of what does it mean to be, well, from a management board perspective, but interacting with the supervisory board in the German governance system, what does it mean to be a director in the financial services sector? So basically, this is a little bit the introduction of Laurent and myself. Laurent will, oops, that was too fast. So, and this is actually what we will talk about today, Laurent.
Yep. Yeah. So we prepared a shorter presentation, very much as a background for discussion. So, as mentioned by Beatrice, feel free to interact with us as much as possible by asking comments, remarks, pointing to mistakes if there are, and I'm sure there will be a lot. And we'll really make pause after each part. We have structured the presentation in 4 parts. First, a kind of reviewing of the environment and some recent events that took place in the banking environment, which will point us to the challenges that the banking and financial environment are currently facing. Of course, you cannot talk about banks and financial matters without having a look at regulation, but we'll try to be quickly of that. And all of that will take us to the specific demand that are waiting on non-executive directors in the financial sector. And we'll see there are a lot of them and that make the role quite specific. So without further ado, let's maybe move on to the environment. Jens, over to you.
Yes, and we will of course via Beatrice or Maya, we will distribute the slide pack later on, because now you will see there are quite some information coming. So basically, I mean, there have been 3 major events from our perspective that are quite relevant to the governance situation in the financial services sector over the past 3 to 4 years. Wirecard, the Silicon Valley Bank, and then Credit Suisse, which is, I guess, not really surprising. I mean, Wirecard, I mean, they faced this kind of a bank run. Just some background on what happened there. I mean, Silicon Valley Bank grew dramatically fast in terms of their business. Then they had a very large portion of institutional money. I mean, and this is quite important as kind of a background. I mean, there were a few institutional investors depositing their, especially from the fintech area, depositing their money with Silicon Valley Bank. And Silicon Valley Bank, on their side, they did what many banks did. I mean, they used the money and invested it in corporate and government bonds on the market. And again, this is something to note, because government bonds are relatively considered to be relatively safe. But with the interest rates then rising and then leading to a cash squeeze on the fintech side, these financial institutions they asked Silicon Valley Bank, we want the money back, and they weren't able to deliver that. They really had a liquidity problem, and in the end of that episode, they collapsed a little bit later. And following that collapse of Silicon Valley Bank, actually there was a kind of a wave effect in the financial market, and that also led to the collapse of Credit Suisse. And from a governance perspective, this is still in strong discussion whether this kind of emergency merger with UBS pressed by the Swiss government is in full accordance with what we might expect being a proper governance. But in the end, I mean, one could also argue that these were dramatic effects in the Swiss market with international effects. So, I mean, in the end, the government in Switzerland forced that kind of merger. But going back to Wirecard, and don't worry, I won't go into every single detail here. But what happened at Wirecard, what we see there, or what we saw there, is that basically the three main lines of defense to a certain extent failed. I mean, first of all, the internal controls and board oversight, which was quite interesting. I mean, if you consider what we learned and heard in the Ecuador sessions, they lacked basically all kind of supervisory board committees. I mean, they didn't have an audit committee, they didn't have a remuneration committee, they didn't have a nomination committee, etc., etc. They all were not formed, as you can see here, until beginning of 2019. Interestingly, when they formed these kind of committees, the chairman of the supervisory board was also the chairman of the audit committee, which in terms of splitting control functions really limits the effectiveness of having the supervisory board and a special audit committee. Then what we also learned about the relevance of the compensation scheme is interesting, because the management was highly incentivized with the share price development, and therefore they really tried to keep the share price up. And in that sense, really get an incentive for in terms of the variable remuneration. And then there was an inherent conflict of interest because also the CEO, he got a loan from Deutsche Bank, and that loan was secured to a certain extent with his Wirecard stocks. And of course, this again leads to a certain conflict of interest, because he doesn't have any interest in the share price to fall, because then he is forced to really put in cash on the table. So I mean, this is just very, very short and briefly 4 examples which were reviewed afterwards, what really failed at Wirecard. But it was not only the internal control and board oversight that failed, it was also the external auditor. EY didn't confirm this cash directly with the Singapore bank, and they basically ignored hints coming from journalists or short sellers in the market. And the effect of that one is that EY is now really facing lawsuits in Germany for completely inappropriate external auditing. And we even need to go one step further. Even BaFin really acted in the most appropriate way during that Wirecard event. First of all, what I wrote here, ineffective whistleblowing. I mean, there were enough hints from investors, journalists, etc., also from employees of Wirecard, that something is not really going well there. But BaFin ignored that completely. And as an example, when the Financial Times published the story about this fraud scheme at Wirecard, I mean, the reaction of BaFin has not been okay to take that serious, but even they started an investigation into FT for investigating whether they really want to manipulate the market. Then they issued a short sale ban, not allowing anymore to short sale on the on Wirecard's stocks. And then the third and the fourth aspect here are quite interesting, because they saw the CEO of Wirecard having a lot of shares in its own company as the major source for trust, that everything the CEO says can be taken seriously, and they ignored this conflict of interest, which we just talked about on the other slide. And then, of course, which the fourth point, which was heavily discussed in Germany at that time, is that also the internal staff rules at BaFin were insufficiently strict, because they allowed dealing in Wirecard stocks instead of really supervising Wirecard appropriately. So this is an example where all three lines of defense failed, and why this whole fraud scheme could happen as it happened, and Wirecard actually then got bankrupt. SVB, I will go into that a little bit faster, but keep in mind what I said at the very beginning, that this bank really grew dramatically. And if a bank grows dramatically, of course, you need to keep an eye on the risk of the bank. But SVB's chief risk officer resigned in April 2022, and the board of directors actually accepted that, and that this for more than 8 months to keep that position vacant. And this is something that is completely unacceptable, and actually caused a lot of criticism to the board of directors, that they really lacked urgency in appointing a new chief risk officer. There has been an investigation actually before Silicon Valley Bank got bankrupt by the Federal Reserve Bank and also the California Department of Financial Protection. And I'm just highlighting, and especially highlighted for, and these are citations. This is not something I wrote. This is basically cited from the report, that they said, okay, the governance and risk management practices are below supervisory expectations. The board has not provided effective oversight to the senior management, really keeping a hand on the risks. And the board also didn't hold the senior management accountable to really close the gaps, to remediate the actions, the weaknesses that has been identified. And in essence, due to that lack of effective board oversight, that resulted in a completely inappropriate risk management program at SVB in all lines of risk categories. You can think of enterprise risk, technology risk, information security risk, and liquidity risk. And liquidity risk has been the one that essentially led to the collapse of SVB, as I explained at the very beginning. So, as I said, you get this afterwards because it's a lot of information, but this is a little bit the setup on 2 to 3 main events that really leads to the question of what does it mean now for governance and further challenges. And now with that, but before we hand over before I hand over to Laura again, maybe you have some questions on that environment. Then we can take these questions right away, and we don't need to wait until the end. Yeah, Verena.
So do you hear me now?
Yeah.
Okay, so I'm a little bit surprised. So I knew on the Wirecard thing, and so I have an audit background, and I was quite surprised to see that the basics in auditing have not been ensured by EY, because this is the first thing you learn in audit school, that you have to do your bank account reconciliations. My question is, so the boards, supervisory boards of management lacking oversight, is it because of a lack of quality, or is it because of a lack of different motivation on the results and the strategy of the company? Because for me, it sounds very easy what were the reasons for the failure. And my question is, do we have to pay more attention on who we do select in boards and on the supervisory boards? And I'm talking for a company who was largely criticized on its general assembly by the institutional investors for lack of governance.
Okay, well, Verena, I'm giving you now my very personal opinion on what could have caused that situation. In my opinion, there was a very positively driven hype around Wirecard during that time, because it was, it was the first kind of German fintech being dramatically moving, being the first DAX company. So this was extremely positively motivated. And what I think is quite telling is also, and this again was a citation of an internal BaFin report. I mean that BaFin actually trusted the CEO more than any kind of whistleblowing indications coming from the market, just because Brown has had a very large portion of Wirecard stocks, which is not that unusual as a CEO, but it's not. I mean, it is highly questionable whether this is the correct basis for being trustworthy. And the second aspect, in terms of what you've said, the first lessons you learn in auditing school. I mean, this is something. I mean, I can't explain that, and I think nobody really can explain why Ernst & Young really failed to do a proper check whether the money is really in the accounts at the Singapore bank. I mean, this is just almost impossible to believe. I think, Kim, you were first, and then Wolfgang, if I saw this correctly.
Thank you. This may go into what you wanted to talk about later in the presentation about the requirements for directors for the future, but just looking at this, it sounds like it has a lot to do with ethics as well, and ethics standards. So maybe a question for you: do you see, are you hearing more demand for ethics experts, for people talking about ethics, talking to candidates who have this kind of expertise for the future, or what's your opinion on that?
Laurent, I mean, maybe then somebody
else. I think definitely in the sense that ethics is really at the core of the selection criteria for an NED in the banking and the financial industry. And I think the regulators, especially at the European level, and there I took either the SSM, which is the single supervisory mechanism with the team of the central banks, are very intrusive in the way the NED are selected for banks. And not only they are selective and intrusive at the beginning, but as we will see in a minute, they are actually able to attend board meetings now. And they can request documents, they can attend board meetings, and they do that very often. And they will therefore check the individual quality of the member of the board, but they will also check the overall dynamic of the board. And I remember when I was in Brussels, one of the European country, and the only one that has ever heard about doing it is, I think in Holland, they are sending shrink to board meetings to check that the dynamic of the board is correct and that everyone is kind of sufficiently interactive. So ethics is definitely on the top of the selection criteria, and they will make sure that it's run properly. I think Wirecard was really at the fringe of that for all of the reasons. And by the way, there was a very interesting, though lengthy, report released by ESMA on the issue, where we have a lot of insight about what actually happened.
Thank you.
And before Wolfgang, before just maybe to add on what Laurent said in terms of processes, Kim, really BaFin changed their setup and their processes dramatically after this event, and they set up a very specific, extremely well-educated team, really covering all the kind of, let's say, in focus banks. And they particularly have the fintechs in Germany, because BaFin is regulating Germany. They have them in focus, and if you take the history of what happened with regulating and overseeing the fintechs and the banks in Germany since the Wirecard scandal, I mean, then BaFin really changed their whole attitude dramatically. They are much stricter. They impose punishments, penalties, etc., and not only on the institutions, but they also cover the board director, the directors of the board, and also the management teams individually. Wolfgang?
Yeah, mine is more a remark than a question, because philosophically, let's say anything that we want to control is, the question is, what do you want to control? How you set up the control? So and you see that in quality. Usually, if you do quality control, you think that everybody is working for a good quality. But if you have a fraudulent system behind, or somebody who wants to fraud, it's very difficult to find. And in internal auditing, and when you have the external auditors, what are they looking for? Usually they will look for individuals within the company that want to fraud, but not if the entire company is fraud. This is not the thing that you would look at first, and that's why you might overlook it. A good CFO should be good enough to fraud against an auditor that is there only for a very short time every year. I would assume if you want to fraud, you can fraud, but it's not the mindset with which we go into any audit, I think.
I'm sorry, I do not agree with you, because
okay, it's good if you do not agree.
Because in my, yes, of course, you cannot prevent fraud because there's a bad intention with the people doing it. But for example, some things in audit are there to detect what is called and to check so-called red flags, at least to give you an indication if there could be fraud in the organization. And as we heard, the auditors have failed to check on such red flags. So at one point in time, even if it's organized crime, you can get them.
No, I'm sure that this is right, and I think that to the 2 billion that were somewhere in Singapore, I would assume that they probably tried at one time, but they never got a meeting with the bank or whatever. But because I would assume that EY tried it, but that they were just led around in circles. But that's my opinion.
But I think what's fair and important to mention, I think, and you, by the way, you have something on Netflix on that, is the overall environment was favorable to Wirecard because it was a very successful story in Germany, a very successful story in Europe. So there was a lot of misalignment of interest in the wrong sense of and all of that made that everyone thought they were doing their job, but they were doing maybe their job with a bit of lower demand, and I think all that led to major failure. I would propose that we advance a lot, because there is quite a lot of ground to cover, and I see the time running. But I mean, this slide is really to try to summarize that unique specific skills if you want to be an NED in the financial and the banking industry. You definitely need to be able to look at financial accounts, and financial accounts of a financial company, and especially a bank, are a bit more complex than a kind of a company in another sector. You need to have some strong skills on risk management, and as we will see in a minute, the risk management is quite wider than I think in any company. There is some legal knowledge which is also required. I mean, as we all know, the regulation of the banking and the financial industry is really very high since the crisis of 2008, 2009. And of course, it's better if you have some inside senior executing experience and background, and it will be a criteria of selection. If we move on to the next slide, Jens, please. Basically, there are quite a number of skills which are required by the changing and fast-changing environment. And I won't go into all of them, but there are a couple I would like to underline. First is everything which has to do with information and communication technology. The banks and the financial sector is going through major transformation. And that has happened even before artificial intelligence started having some effect. The data transformation is crucial. The digitalization of the processes is absolutely tremendous. Hopefully, it will improve the quality of the service, which is in some respect badly needed. But that also opened a larger front to cyber threat, and therefore the channel of cybersecurity is very, very important. As we will see in a minute, it's actually taken fully on board by the regulators with the new regulations, DORA, that will come into effect at the end of this year, that will force the banks, especially, as well as some other financial institutions, to dramatically increase their operational resilience and revisit a lot of that process. So technology is really at the forefront of the changing environment. Of course, we have the ESG paradigm shift. I mean, the sustainable development is really impacting a lot the financial industry, and especially in Europe, because I think the European Union positioned the financial industry as a kind of changing factor in the world economy. And the other thing is really the anti-money laundering and fight against terrorism. And I mentioned that because there will be a new European authority on that, AMLA, that will reinforce all of that. And we know that there is a lot of money going through the system by definition. So that's really specific to the banking industry. On top of that, you have some other issues which are more common to other kind of industries, which are valuation. As you may have seen, the bank valuation remains quite low compared to the US banks, and that's definitely an issue for Europe. And the banking concentration, in the sense that we are lacking major trans-European banks, and there was a lot of recent activity in Spain, as well as a lot of comment in France with Mr. Macron commenting on the possible fate of Société Générale. If we move on to the next slide, Jens, please. The other thing is, of course, the regulatory environment. You cannot talk about banks in the regulatory without mentioning the supervisory and regulatory environment. In terms of supervision, just as a reminder, all of the largest banks, which mean 112 banks, if I recall correctly, are now managed and supervised by what's called the single supervisory mechanism, with joint supervisory teams between the European central banks and the local central bank. And they go through a very diligent, precise reviews, what they call the SREP, supervisory reviews and evaluation process, where they will have a lot of things that they will look at in terms of risk appetite, in terms of internal governance, and all that is really very thoroughly done, detailed processed. You can take to bank executive, they are facing a very tough time, but the memory of the 2008 and 9 crisis is in all mind, and they really want to avoid that. And as mentioned, the joint supervisory teams can attend board meetings, and they do attend board meetings for 3 main reasons: presentation of the board of some new regulations, thematic missions. So if they have done a thematic mission in a bank and they want to present the result, they can do that to the board. And they can also have a kind of a silent presence to the board, just to assess the board dynamic. If we moved on to the next slide, and then we could have spent the whole hour and the next few days on regulatory environment. But what I just wanted to draw your attention upon is the fact that it's a heavy regulated industry, maybe the most heavily regulated now after the pharmaceutical industry. And you have regulations about the stability of the system, and it's a never-ending flow of new regulations. There are regulations about the reliability of the system, and mostly about anti-money laundering. And there is a lot of regulation about the protection of clients, which is all very good for I guess, the overall society, for the consumers of banks, and for us as citizens. But for an NED, that means that you need to be aware of that, because that will impact on the strategy and the running of the bank, and that will have definitely a central role in the discussion at the board level. And the friends of Beatrice at the European legislative bodies, as well as my former friends at the European supervisory authorities, make sure that those regulations are there, they are getting more complex and even more precise. So a lot of things to track and to be aware of when you are at the board of a bank or a financial institution. The next one, we look at the rules in terms of governance. Hans, back to you.
Yeah, sure. I mean, but maybe are there questions regarding this regulatory context Laurent has just highlighted? Because then we can take them now.
You want us to spend the night on it? Huh?
No, I just okay. So actually, besides that, I mean, what there are also now much stricter rules in terms of governance for banks. And now remember what we said at the very beginning with regard to Wirecard and also to Silicon Valley Bank, because now it's mandatory for the large banks with total assets more than 5 billion euro to have these kind of committees, to have an audit committee, the risk nomination remuneration committee, and especially that's why it's highlighted the audit committee. And of course, and this is pretty much this kind of, let's say, I mean, you know, the German governance system, there's an obligation to split the chairman of the function of chairman of the board and CEO in a bank. It can't be held as in kind of union. And then as Laurent already has indicated, there are now very specific interactions between the control functions and the board. The control functions have direct access to the board. The remuneration of the management team of the executives is controlled by the board, and also no executive can be dismissed without the approval of the board. On the other way around, it's also, I mean, no executive can be approved or can be nominated without the approval of the board. So, and if you remember what has happened at Wirecard, I mean, there they lacked having all these kind of committees, at least initially. And then, okay, they didn't have this kind of same role for the chairman of the board, but implicitly it's also now forbidden that the chairman of the board really holds the chairing role of the audit committee. And then summing at least this kind of governance system up and the implications coming from the market, there are much really increased obligations for the board. I mean, it's much stricter in terms of what the internal control system need to deliver. There is a much stricter knowledge required, also in terms of risk management. Just as an anecdote, for example, if you want to become a non-executive director in Austria in a bank, you need to pass a special fit and proper test. And it's not like, I mean, you really need to prepare for that exam. I mean, it's not that strict in Germany, and I don't know for other countries in Europe, but in Austria, you need to pass an exam to become a director in an Austrian bank. Back to other increased obligations, the board needs to be actively involved in the remuneration and especially for the risk takers. And just to explain that phrase a little bit, risk takers are not only the executives in a bank, but there is a much longer list of defined risk takers. Like, for example, the head of compliance is also part of that list. The heads of certain market divisions are part of that risk, etc., etc. So it's not only the executives, but this list of risk takers is much longer than that. And then, as Laurent has already indicated, there are much stricter rules also for the self-evaluation in the board. So that these are outcomes of the developments and the schedules we've highlighted at the very beginning. And what actually does this mean for you if you want to become an NED at a board? This is now again back to Laurent.
Yeah, so indeed, there are specific selection criteria for board members in the financial industry. And those are 5 criteria that will be used for the selection. Unsurprisingly, you would have honorability, and you will presume to be honorable if you don't have any past events that would threaten that. Independence will be quite strictly looked at, and there is an obligation to have strict conflict of interest policies within all the banks. The availability that you may show in your mandate and the number of mandates will be also looked at, and there is a maximum of 4 NEDs that you can take in financial institutions in Europe. And the selection will also focus on the level of experience and skills. And for that, they will look at the individual skills as well as the collective skills. And I can tell you that those days, there is a lot of focus on the technological skills of NEDs for banks because of the new DORA regulation that was mentioning, and because of the level of threat on cybersecurity. And last but not least, it will be the level of diversity. Maybe just to go back. What's important and on top of that, just to mention, there will be an obligation to initiate and to train all of the board members at individual and collective level. All that to say that if you want to apply to a board or to join to a board of one of the 112 banks which are supervised by the Central European banks, or the largest banks, the process takes more than a year. And in some countries, as mentioned by Jens, you have specific exam. And a funny story that I've heard of is that when they check availability, they can require to have a look at your diary and check precisely what you're doing on a daily basis to make sure that you can actually attend a new board. So that's how thorough and precise they will go in their analysis. If we move on to the next slide, which is, I think, the conclusion, and they really opened the floor for debate. What we wanted to show with Jens is maybe draw your attention on the fact that the financial industry is a specific industry by all respect, and we have, I think, strong memories of that. But the consequence of that is because it's perceived as a specific industry, potentially generating specific risk, and I think we all want to avoid, especially the supervisor, to have to use taxpayer money to save banks. Furthermore, there is a regulatory framework, there are specificities, which mean that the governance of a bank is different than any other company, and banks as well as financial players. And therefore, the role of the board and the role of the member of the board is also specific. That does offer interesting prospect, but also specific challenges. And you need to be aware of that. You need to be well equipped for that. And as mentioned, the process can be quite long in order to join the board of a bank. Thanks for listening to us. Very happy to take questions, comments. Once again, we have not covered everything, but the idea was really to give a kind of overview of the issue at stake for those financial sector NED.
Thank you, Laurent. Thank you, Jens. Do we have questions? Yes, I can see Dominique.
Hello, everybody. My question is related more to the first part of this discussion, where you mentioned Wirecard and the trouble with Ernst & Young and so. And I serve on 10 boards in the financial industry. And basically, my experience is that you need absolutely to meet regularly with the auditors, and not only to have a chat with them, but to evaluate them also. I'm saying that because what I have seen over the last 10 years is that a lot of these auditors, they put very young people at work. You have one senior guys overflying the whole thing, but never going really in deep dive mode and checking things. And if you see that, or if you identify this pattern with your auditors, you better have, I will say, maybe a very frank talk with them and bring them back to a more disciplined mode. This was just a comment I wanted to share with you.
No, I think it's a very good comment, and for having worked on, though I was on the consulting side with major editors firm, I think there is an issue with the business model of those firms, and the only way they can make money on those audits is really by having one senior partner, but a lot of junior people. But that's, I think, where also the role of the board needs to be underlined in the sense that you need to have a strong audit committee, and you need to have the ability within the board, at least of some members, to challenge that and to challenge the auditors to make sure that the audit committee conduct its work in a good way, to give access also and to have access to the finance directors, rightly so. And that's why, and the audit function as well. So I don't think we'll be able to change the business model. I mean, I think the regulation has tried to do that, but the business model of auditors is that it's we call it a pyramidal structure when you are in the industry. So you have one senior guy at the top and a lot of junior people. My only hope on the process, and maybe I'm too optimistic, is the AI. I mean, artificial intelligence, I think, will change dramatically the way audits are done, and hopefully for the better. And it will have an impact on the economy of the industry, as well as the quality of the audit. But nothing, I think, will replace having a very thorough discussion with the audit committee for board members, and for the member of the audit committee with the auditors and the finance director. But I think it's a very valid comment. Thanks for that.
Irina?
So thank you for this very clear presentation. I have a question because I was by chance yesterday in a presentation. And what about the demographic effect? Is there still a market, and are there still people who are willing to take on this kind of board positions? Because there's more and more regulatory environment coming. There will be something new on IT environments as well coming from the EU, so the next favorite. So is it difficult to find candidates, or is it still easy? Because I can tell from my perspective, it's more and more difficult even to recruit employees. And so if you see all this liability, legal liability, more and more things like, for example, the Data Protection Directive having personal liability in some jurisdictions. So is there still a market or for, let's say, the next generation, or will this be a problem in the future to get a NED for a financial company?
Well, that is extremely difficult to answer, Verena. But I mean, talking from a personal experience and talking from conversations I had with management and supervisory board members of banks, particularly in Germany, I mean, it's really less and less fun, because for exactly the reasons you've said. And you know, I mean, this combined with the fact that also the regulator, quite rightly, I mean, really poses more and more requests. It takes much more time to be a director in a financial institution nowadays than it has been maybe 10 or 15 years ago. But to your question, personally, I think, and I hope that there are still enough people who are willing to do that and take and invest the time. And this is, I think, the most crucial point. It's not, I mean, of course, being a director, it's a part-time job. But you know, I mean, to be director in a bank and having 10 or let's say maybe even 5 other mandates in parallel is extremely challenging. Maybe it's completely impossible to do this appropriate. And then, of course, with all the increasing requirements, one can run a discussion about whether the remuneration for the directors is still appropriate. But this is a completely different discussion. I mean, in the end, I hope that there are still enough people willing to invest the time and be taking part, really educating themselves, and yeah, actually taking that challenge, because otherwise you really might have a problem in the future. I don't know, Laurent, what's your view?
Yeah, no, I mean, I would agree with that. Maybe to give it a more positive spin, I think what I've heard from headhunters is there is also the perception in some countries that the banks are and will be even more at the forefront of sustainable development, and in a way, they can be really an actor in changing the economy, and they are already. And so by joining a board of a bank, then you are kind of more active in that transformation. And that, I think, is, and then we see a couple of banks becoming B corporation or equivalent of B corporation, which is a US status. And in that way, that give an extra motivation, I think, for NEDs. The other factor I see is that some people that are non-bankers are also interested because of the technological angle. I think there are more and more banks will become technological industries. Maybe we'll see also the other way around. I think there is an issue of valuation for big players to come into the banking industry. So the regulation is really acting as a deterrent. Fully agree with that. But there are some more positive effect, and hopefully they'll be able to have a good NEDs. We need good NEDs, otherwise we'll have a major issue.
Wolfgang?
Yeah, thank you very much for the presentation. It was very clear and very informative. I have a question to both of you. It's about turnover of people, because what we have regulations for board members, we have them for auditors, but we don't have them actually for the executives. So if at a certain point, if your CFO is there for 10 years, your CEO is there for 10 years, they might develop kind of an incestuous relationship that might lead to things that happened at Wirecard, because the pressure is also very high. And to a certain extent, would that help to if as a board member you look at how is the team staying too long the same team, also with the internal auditor and
Okay. Now, I mean, with your final sentence, Wolfgang, you touched on a different topic. I mean, but let's stay maybe on the executive suite level first. Yeah. I mean, actually, I mean, what I experienced, and there are studies in the market. I mean, the average time of being an executive with the same institution is actually decreasing over time. So, I mean, therefore, I mean, yeah. and it might be different in Germany in the saving banking and the cooperative sector. I mean, because they quite have very long cycles and people staying quite long. But of those banks, the private sector banks, so to say, I think the average time of staying on a position in the same institution is actually decreasing and it's not increasing. Whether it makes sense to, on the level below, head of compliance, head of auditing, etc., to kind of enforce a regular switch. I think this is a biased thing, because of course it would be like the same aspect with an auditor to really reduce the danger of being kind of blindfolded. On the other hand, you have the danger of brain drain. So initially, I would say I'm skeptical whether enforcing this kind of regular change is really helpful. I mean, on the level below the executive level.
I would really agree with that, and even go one step further, is that I think the banks have been suffering from the fact that the level of rotation turnover was too high. And you had the system where you could be 2 years, have very big bonuses and leave. And now they have a system where the bonuses payment is scheduled over time in order to kind of increase the skin in the game of the executive. And so the finance director, the head of risk, the head of trading, all the guys are key functions. And in a way, the longer they stay, the better it is for the survival of the bank, because too often they take huge bonuses for 1 or 2 years, especially with the view that they were guaranteed bonus before, and they are still like actually, I think, and so you need to lower the rotation. I would really go rather the other way, but I mean that's my view at least.
Thank you,
Dominique.
Yeah, thank you. I would like just to come back to what Laurent mentioned before, because I think it's a shift in the whole industry. You mentioned that basically we will see more technological people coming on the boards of financial institutions, and we are confronted with the tsunami of AI right now. starting not only with I will say some techie stuff like the blockchain or these kind of things, but AI is a revolution and will change the financial industry. And when you look out for board members able to bring on one side the technological knowledge and on the other side a comprehension, I will not say a full knowledge, but a comprehension of the financial industry, then I will say the aquarium is not so big. And it's quite tricky to find the right people there. What is your opinion on that?
Well, Dominic, just to support what you have said, I mean, just having too many tech or people on the board has been one of the major issues at Silicon Valley Bank, because they very much focused on the technology competence, people coming from the venture capital sector, lacking the traditional banking risk management knowledge. And therefore, in that sense, to just focus on technology is, in my view, the absolutely wrong direction. But I think that was not what Laurent intended. I mean, it's more like, and then we're coming back to the diversity discussion. A good board of, I mean, now we're talking of banks or financial institutions, but actually it's valid for any other industry as well. I mean, we need to have technology competence, we need to have sustainability competence, we need to have risk and audit competence, we need to have industry knowledge, etc., etc. And it's all coming back to a well-rounded team with diverse team covering different aspects of competencies that is needed. But that's what I think was your intention, and just the technology competence is now added to what banks are.
No, fully agree with that, Jens. I think maybe the way to put it in a different perspective is that also while technology was the support of the banking industry before, I think technology will become the main thing in the banking industry. And that's really where we see the reverse. And therefore, the risk will be even higher. And that's why it's so important to that. I mean, if you look at the board of the largest European banks, I think honestly, they are more suffering from a lack of technological skills than an overabundance of technological skills. So they would need to reverse that. But as mentioned by Jens, and I'd see it's one of the cooperative regular diversity at the collective level is absolutely required and has to be maintained. I see a question from Kimberly.
My question is about diversity. So you mentioned diversity is a factor for encouraging dissent, encouraging, risk mitigation, all these sorts of things. There's some great studies that prove that's true. And at the same time, what I have noticed is, especially in the US, but also to a certain extent in Europe, DE&I has gotten very complex. There have been some rulings in the United States recently around DE&I. Kind of curious to see how that'll be in Europe in the future. And I'm noticing there's a lot of need for balance between what diversity looks like and how diversity plays out. I assume this will also happen in the boardroom. So I'm just curious to hear your take on how that balance can look like, and if you're seeing this sort of complexity come into conversations in financial space.
Yeah, I mean, I think, I mean, of course, if this is managed as a kind of an over complex topic, I mean, then we can model kind of diversity and try to find the optimum solution, which personally I think is nonsense. That will not happen. But I mean, what we saw, and what I think what we'll see in the future, I mean, every step coming from this kind of middle-aged white man board structure to a more diversified structure is a good way. And whether then we have one or two additional competencies specifically added to a boardroom team, I mean, well, I mean, I'm not sure whether this really helps, but in the end, I wouldn't personally, I wouldn't make it too complex, but look for a well-rounded set of competencies. But to get this more and more regulated, I'm not sure whether this, again, I'm not sure whether this will really help. I mean, we are tackling the gender diversity for good reasons, but even there we don't have regulations in every country, again, for very good reasons.
Thank you.
So I would be more positive on regulation. I think, I mean, being a French and a bit of a tradition French country, I think, I mean, we had two big laws in France. One about board diversity in 97, if I recall correctly, and one about executive committees, which is coming into force in 18 months. And I'm proud to say that the diversity at the French board level is actually higher than in Norway now. So that's quite a performance. And I think we need to achieve that diversity even for more at the executive level, which is a bigger challenge, I think.
Can we take a last question? Question from Martins?
Mm-hmm.
Hey, thanks for discussion. My question is regarding those more and more new competencies what we need in the boardroom. Do you see as option that we could use not only board members, but also maybe independent experts within board committees as additional source of knowledge and expertise and potential? Have you seen that? Thanks.
Well, yeah. I mean, then these people are maybe not specifically a board member in their official capacity, but they are an expert to a committee. I mean, this is happening, definitely. Yeah.
Just to bounce back on that, and just to as a finishing note, I mean, there was an interesting article from Harvard University saying, could we have an AI engine as a board member? And I thought that was an interesting prospect to look at.
Just maybe to react on that, just to let you know that at ECADA level, we are working on a note, a paper on external expertise at board level. So we will be digging into this topic, Martins. Excellent. So I think it's time to thank you very, very warmly, Laurent and Jens. I think you did a fantastic job. It was really insightful. We will put the recording on our YouTube channel, so everyone will be able to look at it. I would like to let you know that it was the third edition of our Fireside events. In fact, in the past, we had one session focusing on what it means being a board member in family businesses. The other one was, and it was with Rodolphe, who is online with us. Another one was focusing on employee representatives at board level, and Wolfgang was one of our volunteers. We had today this one on the financial sector. If you have any ideas about a topic for the next Fireside event, please come to me and make some suggestions. I was thinking about maybe tackling the topic of what does it mean being a committee chair. I don't know if you feel that would be relevant. If you have any other ideas, please let me know. And if you want to volunteer, please do so as well. And I will promise that next time I will turn to ladies for the sake of diversity. So thank you everyone. Take care, and we stay in touch.
Thank you, everyone. Bye-bye.
Thank
Have
you.
a nice evening. Bye-bye.
Thanks. Bye.